You probably assume Starbucks makes its money the obvious way. It buys coffee beans cheap, turns them into expensive drinks, and pockets the difference. That's not wrong, but it's the smallest and least interesting part of a much stranger business. Starbucks makes money from real estate psychology, from money customers hand over and never spend, from two entirely different business models running at once under a single green logo, and from a workforce experience it built for over a decade and then began quietly dismantling. Understanding why a coffee company almost broke itself trying to serve coffee faster tells you something bigger about how consumer businesses actually generate value and how easily that value can disappear. Start with the part everyone assumes drives the profit, the drink itself. A tall coffee has always carried a strong gross margin. The raw ingredient cost of coffee, milk, and cups is a small fraction of the price on the receipt. That's true of almost any prepared beverage business. It's why coffee shops, not grocery stores, are the ones that can afford prime real estate on a busy corner. But gross margin on a cup of coffee is not the same as profit for the company. By fiscal 2024, Starbucks company-operated stores were producing an operating margin of roughly 7.9%, having fallen from around 15% the year before. That's the number left over after rent, wages, benefits, marketing, corporate overhead, and everything else gets paid. A company selling a product with an eye-wateringly good ingredient markup was still only keeping about 8 cents of real profit on every dollar of revenue, and that number had just been cut nearly in half in a single year. If coffee were really the whole business, that swing wouldn't make sense. Something else was doing a lot of the heavy lifting, and something else had just gone wrong.
That something else starts with where Starbucks decides to open a store in the first place. For years, real estate analysts and appraisers have tracked what's informally called the Starbucks effect. Homes located near a Starbucks tend to appreciate faster than homes that aren't. A widely cited Zillow analysis found that between 1997 and 2014, homes within a quarter mile of a Starbucks rose in value by about 96%, compared with roughly 60 to 65% for the average U.S. home over the same stretch. And in cities like Boston and Philadelphia, the gap was even larger. Zillow's own researchers have debated whether Starbucks causes this appreciation or simply shows up in neighborhoods that were already about to rise. Their conclusion was that it's both. A store that follows early signs of growth and then reinforces them by drawing more foot traffic and more retail investment behind it. Either way, the practical result is the same. Starbucks became a kind of certification stamp. When a Starbucks moves into a neighborhood, it signals to developers, landlords, and other retailers that the area has crossed some invisible threshold of disposable income and daily foot traffic. That signal has commercial value that has nothing to do with the coffee itself, and it's part of why Starbucks employs teams of site selection analysts poring over demographic and traffic data before a single espresso machine gets installed. The location isn't just where the store happens to be. In a real sense, the location is a product Starbucks is selling to the surrounding commercial ecosystem, and that's before a single customer walks in. Now look at what happens after the customer walks in, because this is where the business gets genuinely strange. When you load money onto a Starbucks card or the Starbucks app, that money doesn't count as revenue yet. It sits on Starbucks' books as a liability called deferred revenue, essentially an interest-free loan from millions of customers, held until they redeem it for a drink. By 2024, customers were sitting on roughly $1.77 billion in unredeemed Starbucks card and app balances at any given time, up about 9% from the year before. That's not spare change. It's a float larger than the market cap of many public companies, generated for free simply because customers prefer to prepay. But the more interesting number sits inside that float. Historical redemption data lets Starbucks estimate that a predictable portion of loaded balances will simply never be spent. Cards forgotten in drawers, app balances abandoned after someone switches phones. Once that likelihood becomes high enough, accounting rules let Starbucks recognize that unspent money as pure revenue, a practice called breakage. In fiscal 2025 alone, breakage added over $222 million directly to the top line, money customers handed over and then, functionally, gave away.
Labor advocates and some investors have pushed Starbucks to disclose this figure more transparently, arguing that in some past years, it may have been the difference between the company beating or missing Wall Street's earnings expectations. Whether or not that's true in any specific quarter, the mechanism itself is real and confirmed in Starbucks' own financial filings. A coffee company is also, quietly, running something that behaves like a small no-interest bank and profiting from the fraction of depositors who never come back to collect. Here's where the picture gets even less like a normal retailer. Starbucks doesn't actually run one business. It runs two, under the same brand with radically different economics. Company-operated stores, the ones Starbucks builds, staffs, and controls directly, generated around 82% of total revenue in recent years and deliver the highest per-store sales, often close to $1 million a year at a healthy location. But they also carry the highest costs: real estate, wages, benefits, inventory, everything. Licensed stores, the Starbucks counters tucked inside grocery stores, airports, and hotels, run by a local partner rather than by Starbucks itself, generate far less revenue per location, contributing roughly 10–12% of total company revenue. But Starbucks doesn't pay the rent, the staff, or the equipment costs on those locations. It collects a margin on the branded products it sells to the licensee, plus a royalty on what gets rung up at the register. As a result, licensed stores consistently post a lower gross margin than company-operated stores, but a higher operating margin because almost none of the operating risk sits with Starbucks. It's a strategy that resembles franchising without officially being franchising, letting Starbucks put its logo in thousands more locations than it could ever staff and lease itself, while quietly shifting the financial risk of those locations onto someone else. The flagship stores build the brand. The licensed stores multiply the brand's physical footprint at a fraction of the exposure. Neither model alone explains Starbucks' scale. It's the combination that does. All of this, the real estate signaling, the float, the dual store structure, depended on one underlying asset that doesn't show up cleanly on a balance sheet: the feeling of being in a Starbucks. Howard Schultz built the modern company on the idea of the third place, somewhere between home and work, where a customer could sit, use the Wi-Fi, and linger without being rushed. That lingering wasn't a side effect. It was the actual product being sold at premium prices, because a $5 latte is much easier to justify when you're also renting 45 minutes of comfortable seating and ambient noise. But comfort, staffing for comfort, and space for comfort are expensive. And over the 2010s and early 2020s, Starbucks came under increasing pressure to make stores faster and more efficient instead. Mobile ordering exploded, drive-through formats multiplied, and stores were redesigned around throughput rather than dwell time. On paper, this looked like a win: more transactions per hour, more revenue per square foot, less idle staff time. In practice, it started quietly hollowing out the exact thing that had justified the pricing in the first place. That tension didn't stay theoretical. It became one of the clearest chain reactions in recent retail history. As Starbucks leaned harder into mobile order ahead and app-driven promotions to chase transaction growth, cafes designed for sitting and conversation increasingly filled up with people picking up mobile orders and leaving, or standing in crowded pickup zones waiting for drinks. Baristas, already stretched by rising order complexity and customization, absorbed the strain of serving both in-store customers and a growing wave of digital orders arriving in bursts. That operational pressure fed into a wider period of labor organizing across U.S. stores, adding friction, occasional boycotts, and public scrutiny to a brand that had spent decades cultivating a progressive, employee-friendly image. At the same time, competitors, from regional chains to McDonald's expanding its own coffee offerings to fast-growing entrants, undercut Starbucks on price and speed, while price-sensitive customers pulled back on discretionary spending. Individually, each pressure was manageable. Together, they became a measurable collapse. The numbers made that collapse impossible to spin. In the fourth quarter of fiscal 2024, Starbucks global comparable store sales fell 7%, with U.S. comparable sales down 6%, driven by a striking 10% drop in the number of transactions, only partly offset by customers spending slightly more per visit. China, once a core growth market, saw comparable sales fall 14% in the same quarter, amid intensifying local competition. For the full 2024 fiscal year, global comparable sales were down 2%. The company's weakness, notably, had actually begun as early as November 2023 and steadily worsened through the following year. Starbucks itself, in its own public disclosure, attributed the decline to a challenged customer experience, corporate language for the exact contradiction the script has been tracing. The company had optimized its stores for speed and app-driven frequency, and customers, in aggregate, responded by simply showing up less. The clearest way to see how this played out is through what happened next inside the company's leadership. In August 2024, Starbucks board removed CEO Laxman Narasimhan after roughly a year and a half in the role, an unusually short tenure for a company of that size, and unexpectedly named Brian Niccol, who had just led a highly regarded turnaround as CEO of Chipotle, to replace him. Niccol started in September 2024, inheriting a business with falling transactions, a demoralized frontline workforce, and a stock price that had lost significant value over the preceding year. Within his first month, he laid out the name of his strategy, Back to Starbucks, a plan built around slowing the relentless push for speed and instead reinvesting in the in-store experience, bringing back a condiment bar, using ceramic mugs for customers staying in store, simplifying an overloaded menu, and rolling back some of the discount-driven promotions that had trained customers to expect ever cheaper prices. The company also committed more than $500 million in additional labor hours, expanding staffing on the busiest shifts specifically so baristas could handle both the counter and the flood of mobile orders without the two lines colliding into chaos. Notably, none of this involved a flashy new product launch. The turnaround bet was almost entirely about restoring the operational conditions the original third-place model depended on, proof that the erosion of that experience, not a change in what customers wanted to drink, had been the real driver of the decline. The results took time, and they weren't smooth. Store growth in North America continued, even as comparable sales kept falling through much of 2025. And the company scaled back new store openings to redirect capital toward renovating its existing cafes, rather than chasing its earlier goal of tens of thousands of new locations. By late 2025, some analysts noted a fading of the old Starbucks effect itself, as the company confirmed plans to close around 400 underperforming stores and reduce roughly 900 corporate positions, a sign that not every location built during the growth at all costs years could be salvaged. But by the spring of 2026, Starbucks reported its first quarter of simultaneous revenue and earnings growth in more than 2 years, with same-store sales up more than 6%, driven by both rising traffic and larger average purchases, particularly across the U.S. It was an encouraging signal, but company leadership was notably cautious even in that moment, acknowledging that discretionary consumer spending is often the first thing cut when the broader economy softens, and that the brand's resilience hadn't yet been tested through a genuine downturn. That caution is the honest way to frame where this actually leaves the business. The optimistic outcome is straightforward. Starbucks successfully re-anchors its identity around the in-person experience. Staffing investment pays for itself through returning customers and larger baskets. And the real estate signal, the float, and the licensed store network keep compounding quietly in the background while the core brand stabilizes. The realistic, more fragile outcome is that recovery remains partial and uneven. Strong in some markets, still strained in others like China, vulnerable to any dip in discretionary spending, and dependent on management continuing to resist the same short-term pressure towards speed and discounting that caused the problem in the first place. The failure scenario, the one that 2023-2024 numbers already proved is possible, is a company that keeps optimizing the visible metrics, transactions per hour, app downloads, loyalty signups, while the underlying reason customers were ever willing to pay a premium quietly erodes underneath those metrics until the sales figures catch up all at once. So what is a business like this actually selling? Not coffee. Not really. Coffee is simply the transaction that makes everything else possible. It's selling a location valuable enough to lift the price of the real estate around it. It's selling prepaid convenience that for a meaningful slice of customers quietly becomes free money never collected. It's selling its own brand twice, once at full operational risk in its flagship stores and once at minimal risk through partners who take on the lease and the labor. And underneath all of it, it was selling a feeling, permission to sit somewhere pleasant for the price of a drink. When that feeling degraded in the name of efficiency, the coffee,
The real estate signal and the float were still there, but the number of people willing to pay for the whole package started to shrink. That's the real lesson sitting inside this business. The most valuable part of a company like this was never the thing on the receipt. It was the experience that made paying the receipt feel worth it. And that's exactly the part that's easiest to erode without anyone at headquarters noticing until the sales numbers say otherwise.